Imagine this. Mortgage rates have hit an 8% high for the first time since the turn of the millennium. Quite startling, isn't it? This surge is shaking the housing market, with homes becoming increasingly unaffordable. It's like a game of musical chairs where the music has abruptly stopped, leaving many potential homeowners standing bewildered and empty-handed. In response, forecasts are predicting a continued uptick in prices. It's a seller's market, and builders are capitalizing on this trend by introducing incentives to attract buyers. But these incentives are like a band-aid on a deep wound. They may offer temporary relief, but fail to solve the root issue. The ripple effect of these soaring mortgage rates is far-reaching, impacting everyone from first-time home buyers to seasoned real estate investors. The housing landscape is shifting beneath our feet, and now, more than ever, it's crucial to stay informed. The question now is, how does this affect you as a potential home buyer or a current homeowner? The Federal Reserve's decision to pause rate hikes has caused a ripple of concern through the market. This pause is a response to a mix of factors, chief among them, concerns over financial conditions and our nation's towering, unsustainable debt. The Federal Reserve is the rudder of our economic ship, and its decisions can have profound impacts on our financial journey. This pause is not without its reasons. The Federal Reserve is well aware that rate hikes can have a lag effect. This means that the impact of their decisions isn't immediate, but rather felt down the line. This can lead to a delayed reaction in the economy, and this pause allows them to reassess the situation and plan accordingly. So, while this pause might be causing some to furrow their brows in concern, it's a calculated move. It's a chance for the Federal Reserve to take stock, reassess, and steer us in the right direction. It's clear that the actions of the Federal Reserve have far-reaching implications for us all. Looking beyond our borders, the long-term performance of the global stock market is riddled with uncertainty. A prime example of this is Japan's economic downfall, which serves as a cautionary tale for the rest of the world. The land of the rising sun experienced a prolonged period of low interest rates and economic stimulus, a strategy that ultimately led to a devastating economic bubble in the 1980s and a subsequent financial crisis that the country is still grappling with today. This unfortunate series of events in Japan is not an isolated incident. Economic systems are interconnected, and the ripple effects of one nation's financial decisions can and do reach the shores of other countries. This gives rise to the question, could a similar situation befall the United States, or indeed any other major economy? The answer is not straightforward. However, the possibility cannot be dismissed outright. It is here that the importance of diversification comes into play. By spreading investments across a variety of assets and countries, investors can mitigate the impact of any single event. This diversification acts as a safety net, cushioning the blow of potential financial downturns. But diversification is not just about spreading risk. It's also about seizing opportunities. As some markets falter, others may flourish. By diversifying investments, you're not just protecting yourself. You're also positioning yourself to take advantage of growth wherever it may occur. However, there's no one-size-fits-all approach to diversification. It's a strategy that should be tailored to individual financial goals, risk tolerance, and investment horizon. But regardless of the specifics, the core principle remains the same. Don't put all your eggs in one basket. In a global economy, what happens in one corner of the world can influence what happens in another. So whether you're an investor, a homeowner, or just an interested observer, it's crucial to keep an eye on global market trends and risks. Because in today's interconnected world, no market is an island. Now let's address the elephant in the room, the possibility of a recession. This topic brings with it a whirlwind of theories, speculations, and predictions, all of which are as varied as the people who make them. Some analysts see the economic imbalances as a red flag, warning us of an impending downturn. They point to factors like high debt levels, income inequality, and unsustainable growth rates. Others, however, are more optimistic. They believe in the resilience of our economy, emphasizing positive GDP growth, robust consumer spending, and favorable employment data. But here's the catch. Economic indicators can often present a contrasting picture. Consumer sentiment, for example, is a double-edged sword. High consumer confidence can drive economic growth, but it can also lead to overconsumption and debt. The same goes for GDP growth. While it's generally a good sign, it can mask underlying issues such as income disparity or environmental costs. While the future is uncertain, being prepared and informed is key to navigating any potential economic downturn. In the stock market, a small number of tech giants hold a significant sway. These behemoths, with their enormous market capitalization, wield an enormous influence on the S&P 500, a market index that tracks the 500 largest companies listed on the US stock exchanges. When these tech giants sneeze, the entire market catches a cold. Consider this. The top 5 companies in the S&P 500, all technology companies, account for almost 1/5 of the index's total market capitalization. That's a staggering amount of influence concentrated in just a handful of companies. And when these companies experience even the slightest fluctuation in their stock prices, the ripple effect is felt across the entire market. But why does this matter to you and me? Well, if you're an investor, or even just a casual observer of the stock market, it's crucial to understand the outsized influence these companies have. It helps us make sense of market movements and, perhaps more importantly, the potential risks and opportunities that lie ahead. Now, let's turn our attention to the Federal Reserve, the central banking system of the United States. Given the current market dynamics, the Fed has adopted a cautious approach. The pause on rate hikes, as we discussed earlier, is part of this cautious stance. While this pause is intended to allow for a reassessment of financial conditions and the national debt, it also signals the Fed's concern about the state of the economy. This cautious approach, coupled with the dominance of a few tech giants, creates a unique and somewhat uncertain landscape for the stock market. The interplay between these factors will undoubtedly shape the market's trajectory in the coming months and years. In a world where a handful of companies can influence the market, it's important to keep an eye on the bigger picture. Understanding the broader market trends and the actions of key players like the Federal Reserve can help us navigate this ever-changing landscape. And that, dear listeners, is the essence of savvy investing. Let's take a moment to recap what we've learned today. We started with the startling mortgage rates and how they are currently shaping the housing market. We then moved on to the Federal Reserve's decision to take a pause, a move that reflects its cautious approach given the current economic conditions. We also discussed the global market trends and risks, and speculated on the possible recession looming around the corner. And we delved into the power of tech giants in the stock market, their influence on the S&P 500, and the ripple effects their fluctuations can have on the entire market. The landscape of the stock market is complex and ever-changing, but understanding the broader trends and the actions of key players can help us navigate this dynamic terrain. As savvy investors, it's crucial to stay informed and prepared in the face of economic uncertainty. Remember, knowledge is power. The more we understand about these financial machinations, the better we can anticipate and react to changes in the market. If you found this deep dive into the world of finance and investment helpful, don't forget to hit that like button and subscribe to our channel. We regularly provide insights that can help you make sense of the complexities of the financial world. So stay tuned for more, and until then, keep investing wisely.